G'day folks, welcome back to another update for the German DAX and the Japanese Nikkei. Now the German DAX is showing a bearish momentum and the Japanese Nikkei is showing a bullish momentum. However, just watch for a retrace on both, meaning the German DAX may go further to the upside in the short term, and the Japanese Nikkei may retrace back to a bearish momentum in the short term as well. We'll include some backtesting to show you some trading strategies for your consideration. Before you go any further, make sure you hit that like and subscribe button to support the channel. In terms of the outlook, as of today, June 19, the German DAX benefiting from capital inflows as US equities appear overvalued, break out above 24,050 to 24,200 points, could reignite upside momentum. Analysts project the DAX reaching 25,000 by 25,500 by year-end 2025, driven by strong exports and gains among key domestic tech and industrial companies. The Nikkei trading near 37,800 to 38,000 points, with modest downside, around minus 1.9% forecast for June, then recovering into year end. Reuters analyst poll sees a 5% upside towards 39,600 by end of 2025, with further gains to 40,900 by mid 2026, underpinned by a weak yen, low rates, and solid corporate earnings. Okay, so let's start off with the long-term trends, and we always look at the monthly, the weekly, and the daily. So on the monthly, first off, in terms of direction, the DAX is very bullish above the moving averages on the price, and also above the moving averages of the commodity channel index we've got down here. Now, have highlighted these fair value gaps down here in red rectangles, and that's potentially where orders have remained unfilled. So we might see if the price does collapse. This is a very long-term play. We expect the price to retrace back to those areas. Again, that's a very long-term play. Don't go placing short orders based on that alone. We're just giving you a very long-term outlook. In terms of the weekly, likewise, we've got this somewhat bearish to neutral positioning on the CCI. You can see there what's happening here? The CCI is broken into that moving average range, and the price is also retracing back towards the moving averages. The price is still bullish, although last couple of weeks you'll notice here we've got some pretty strong bearish candles, and this week so far. So again, I wouldn't be going long at this point with that CCI into that moving average range. And if we zoom in, eventually when this responds, you can see here we've got a very long-term play as well, in terms of a bearish fair value gap, and similar to the monthly outlook. First of all, we've got this bearish divergence here, lower highs on the CCI versus higher highs on the price, and it's already coming towards that. And that blue area is the divergence target, that 23-38% range. This red area, if I zoom in there, you can see there's a few grey areas within that after those candles. They're fair value gaps, and that's why I've highlighted in red. And again, we expect the price to retrace back into that area, and that also coincides with this bearish divergence target. We had a fair value gap here. You can see that was filled quite easily. Another small one there that was filled, and these other ones back here were also filled by these candles. So again, this was another bearish divergence, a long-term play, and it hit that 23-38% target. But look at this one down here. We've got a fair value gap as well that hasn't been addressed yet. And we may see the price retrace back down, and that also coincides with the monthly outlook as well. On the daily chart, it's already hit this resistance up here at 24,355. Now, since our last video, we did project a bearish trades to be taken only, and that's already continued, and the price has remained below that moving average, and so is the CCI, so bearish trades only to be taken. And again, on the daily, we've got this bearish divergence target, this blue area, and hasn't quite reached it yet, but also coincides with this small fair value gap range. So again, the price at the very least will reach down to this area in the coming days or even weeks possibly. We can't really tell how long it's going to take. And another fair value gap down here which will likely be reached as well. So at the moment, bearish momentum on the daily for the German DAX. Now if we go to the intraday chart, I've got the daily here as a reference, so short trades only. But notice here on the 1 hour time frame, we've got higher lows on the CCI versus lower lows on the price. Now this is still dropping, so don't go placing long. I don't trade these. I wouldn't place a long order on this. I'd wait for this So if you're going short during this period, you may want to get ready to get out, and I would probably wait for it to break above the moving average of the price before getting out and taking your profits if you're already in short positions here. But at the moment, you'll see it's since I drew that trend line, the price is actually, and the CCI, the price is leveled off slightly, but the CCI is still dropping. This could keep dropping, and if it does keep dropping below that low there, we're going to invalidate the divergence. But at the moment, wait for the price to retrace higher, and in which case we should see the CCI also start moving in line with the price as well. There's a small fair value gap there which hasn't been hit, so if it does retrace back, that's an area we expect it to hit likely. But again, assuming it starts rising from there, and it may not, we've got to wait for it to confirm. And that also coincides with that fair value gap, that 23-38% range. So that coincides with that as well. So if we start seeing a retrace from where it is at the moment, that's our initial target area. Again, wait for this to break above that moving average range, and by then I should see the CCI also break higher as well, which will start moving in line with the price, which is what we normally see. Now, in terms of trading, backtesting, we've got the short positions only. So what I'm showing you now is going to be the short positions here, going back to, that was the 9th of June, which is this period back here on the 1 hour time frame. Got the stop loss approach here and the average down approach. And the stop loss, I've got both of them at a $100,000 baseline, and I'm not asking you to have $100,000 in your account. I'm just showing you that as a baseline for the back test. You can see here it's dropped off, had a couple of points above the 100,000 baseline, and then more recently it's dropped off with the stop loss approach. The average down approach otherwise here is averaged down a few times, and it's done quite nicely. Now, that's assuming you let it run through the whole period. What I'm suggesting you do is, at the very least, wait for this to break into that moving average range to close out your positions. So at the moment, you're down about $1,000. Sorry, you're down about $100 on the stop loss approach, and you're up about 9,700 on the average down approach. But notice here, like I said on the hourly, we've got a bullish divergence versus lower lows on the price. I've already drawn those targets. So if you've been going short for some time and you're happy with that return, I would probably start taking profits and get out of the trade and wait for the CCI and the price to start moving in alignment. So for the Japanese Nikkei, again looking at the long-term trends, the first thing we look at is the trend above the moving averages. So the price here is still above the moving averages, but notice the moving average band is slightly bending or contracting. That's not a good sign, like it did back here. That's probably a response to this bearish divergence. The CCI is below the moving averages, even though the price is above. And again, it looks like it's already broken to the downside. So if I was to draw a Fibonacci retrace on that, from that high to that low, you can see it's broken down to the 61% range. So that divergence has already played out theoretically. So I'm not going to worry about that so much. So the first thing we look at is the trends on the moving averages. So somewhat bearish to neutral on the monthly. On the weekly, both the price and the CCI are above the moving averages. And that's the first thing we look at. And then we look at for any divergence. And you can see there, longer term, we had a couple of bearish divergence, and both of them broke down, hit their targets. I'll come back to the fair value gaps in a moment. But on the daily, you can see there that's still bullish with both the price and the CCI trending above the moving averages. That's the first thing we look at, is the trends. Next, we look at any divergence, which we've already talked about, and there's no divergence on the daily. And the third thing we look at is the fair value gaps. Now, the fair value gap here on the monthly, there was one back here, but you can see there those 3 wicks of those months penetrated about 25% of the fair value gap. So theoretically, they've already been filled, but there could be potential downside there. There was another fair value gap here. And again, these are very long-term plays on the monthly. That was broken below to about the 75% range of that fair value gap with that wick. And there's another one down here which hasn't been filled. So that's a potential red flag. Pardon the pun. So that hasn't been filled yet. So just be aware of that. Again, it's a very long-term play. If we start seeing a crash in the Nikkei, you may very well see the price break down towards that level, which also coincides with this moving average 200 that I've drawn on it. On the weekly, In terms of fair value gaps, the more recent ones are here. Again, that one is broken about 25% that week. This one here hasn't been filled at all. So at the very short, well, on the weekly trend at least, we may see a pull back towards that area. Again, don't trade that. I don't trade on those alone. I use the trending CCI moving averages to trade. They're potential areas to look out for if the price does break lower. There have been other fair value gaps in the past, and they've all been filled with these wicks and candles that have happened subsequently. More recently, here on the daily, there was another fair value gap there, but that's been filled about 75% of it with the wick of that candle. That little one there's been filled, all of it. And there's another little narrow one there that hasn't been filled yet. So again, that around the 34,600 level, that sort of coincides with this area as well. So we might see the price break to the downside of that. So again, don't trade those. I'm just giving you an indication where the price may fall sometime in the next few days, weeks, or even months, or even years on these plays. If we go to the intraday chart, this is the daily showing us bullish momentum, and this is the 1 hour chart. Now again, I've drawn here a bearish divergence, lower highs on the CCI versus high highs in the price, and that's already penetrated. The blue area has already been penetrated with the divergence, but it still could have a further downside to go. And also I've highlighted here a fair value gap that hasn't been filled yet. So the price may actually fall down into that area. So again, keep an eye on that. Even though the daily is bullish, I would not be going long at this point until we see the CCI and the price break higher on the 1 hour time frame. Now to show you the bullish back test here on this one, we go back to this period, and what I've done, I've gone back to the stop loss approach and the average down approach, starting back here around about the 26th of May, and that's where the price started doing well. In this case, the stop loss approach has done okay, 4,800 if you let it run through the whole period, and this is the average down approach. This one has generated 25,100, but notice this drawdown. So now, to show you how to avoid that drawdown, when you follow this, at the very latest you should get out of the 1 hour trade. If you're trading on the 1 hour or the intraday time frame, at the very latest you should get out when the CCI on the daily touches that or breaks into that moving average range. So it would have been around there, and that equated to about this area on both the stop loss and the average down. But if you were trading the average down approach, how do you get it? How do you avoid this? If you'll notice here on the CCI and the price on the 1 hour time frame, you've got a bearish divergence, and that's how you use the bearish divergence, or how I use it at least. If you see lower highs versus higher highs in the price, and then you see the price break below that moving average range, that's an indication that the bearish divergence is executing. So had you got out there, even when it hit that range there, that was the 23-38% range of the Fibonacci range. Let me just draw it for you so you can, I know it's getting a bit busy, but that's at 23-38% range, that blue area. Just clean it up a bit. So at the very least, when it hits that range, so you would have got out somewhere in that range when the price hit that range there, and a stop loss approach, you would have generated about 2,900, and you would have generated about 9,500 at that point. Even though you had a few positions open there, you would have closed out with a very small loss compared to what you would have got had you stayed in it. So be very careful and take your losses where you see them, especially with divergence. Now, in this case, the CCI kept dropping, the price kept dropping, and you would have probably got back in a trade somewhere around this area where the price and the CCI started moving higher. Or at the very, actually would have been up in this area here on the daily around the 6th of June, so it would have been around this area. You would have got in, not this area here. That was still bearish based on the daily being below the moving average range. So you would have got in somewhere there, and that would have done quite nicely as well. But notice again, we had another bearish divergence there, that smaller one, and you would have got out somewhere there as well. So that's how you trade using the divergence. Also use these fair value gaps as indications where the price may end up falling to possibly. And I've got these on the 1 hour time frame. That one up there has been filled with those candles. This one's been filled, and this one down here hasn't been filled yet. Hence, as well as a bearish divergence, we've also got this 1 hour time frame fair value gap that hasn't been filled yet. A video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. So if you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.